So there's this investing quote that goes something like this. Investing is like a bar of soap. The more that you handle it, the less you have. Just think about it. You kind of have a bar of soap. It's wet. If you're using it a lot, the soap gets used, the bar gets smaller. And a lot of people look at their investment portfolio the same way. Wise investors look at their investment portfolios and they know the more changes that they make, the less they may have because those changes may have adverse effects. Now, I generally agree with this quote, especially for a seasoned investor like myself, but a newer investor, someone who's brand new to it, I do think there are going to be a few more adjustments along the way because newer investors, they're going to make some more mistakes and they may have to correct those mistakes over time. But again, when you get more seasoned, fewer mistakes, fewer changes, let it be, let it grow. Anyways, I'm a dividend investor. I want to talk about today how I evaluate stocks for actually selling them. I own 40 stocks. How do I determine in my portfolio if I want to sell a certain position? That's what I'm going to go through today. And I want to go through it this lens of sell, 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 especially from the standpoint of Kraft Heinz, ticker symbol KHC. Kraft Heinz is just tanking. The stock is doing horribly. It's in the news. I just did a video on this. I'll link in the description below. I don't own any Kraft Heinz, but I know a lot of investors in the community here invest in Kraft Heinz and they invest in it for the dividend. And so it's really disappointing when on Friday it's down 27%. On Monday it's down another 2.1%. On Tuesday it's down another 3.2%. The losses just keep piling up. And investors are wondering, should I just sell, sell, sell? Should I run for the hills with this thing or not? It's a really interesting story. And in fact, this stock kind of reminds me of a stock that I sold. I'll link in the description below. I did a video on my top 5 biggest investment mistakes. I bought this stock all these years ago in 2014. And this is actually, I've been investing for a very long time. So this is one of my most recent mistakes. I bought this company, BHP Billiton. I did all the fundamental analysis, but more or less, I bought this stock because everyone else was buying it and I thought it was the thing to do. Anyways, the stock did not perform well. The company ran into some troubles. I did not have the conviction to hold it because it really wasn't my own idea. It wasn't a company where I generated the idea. It wasn't something that really belonged in my portfolio, even from the beginning. So I sold it in 2016. And Kraft Heinz really reminds me of BHP Billiton. Interestingly enough, if I'd held BHP Billiton, I would have been just fine. The company has recovered. They've increased the dividend again. They're doing just fine. So even if this bar of soap, I handled it. I handled the bar of soap. I got rid of BBL and I bought some other stocks. And I did just fine as well because I replaced BBL with some really good stocks. That being said, if I did not handle the bar of soap, if I just left it alone, I would have been just fine as well. And what's funny is Kraft Heinz really reminds me of this in so many ways. Way number 1 is when I did my first video on this topic. I'll link in the description below. I absolutely hated the company. There's just no way I was going to buy it. But over time, the community kept talking about it. Everyone loves it. The dividend investors love it. I added it to my watch list, and I was seriously thinking about buying it. I never bought it, but I got close. Kind of like BBL. The community influenced my reasoning. Also, though, like BBL, this company has run into some tough times. They've cut the dividend, but personally, I don't own this, and I'm just speaking from personal experience, though. If I hypothetically did, I would probably hold the thing because I'm a more seasoned investor than when I bought my BBL, and I've learned a few things even in the last few years. And I kind of feel like this company, it's not a General Electric. This is a company that will probably do okay in the long run, and it's probably prudent just to sit and wait. That's my high-level take on Kraft Heinz. There's a lot of parallels with BBL here. And quite frankly, I don't own any now, but maybe I'll buy some if it hits the 20s. Although I really don't need it in my portfolio. I've got enough exposure to the consumer packaged goods, food industry. I'm good there. And the companies that I own, like General Mills and Campbell's Soup, I believe they are superior holdings. And so I am fine there. I probably won't own it, but maybe I will if it hits the 20s, if it goes on fire sale. But I want to talk about this today. I want to talk about when I sell a stock. But before I do that, a while ago on this channel, a lot of folks were asking about GE, General Electric. There's some people here own General Electric. The stock started falling, and they were wondering, Ian, What would you do? Would you sell? Would you not sell? And I can only speak from personal experience here, but what I did is I shared a framework. And so I will link in the description below to that framework. But what I want to do today is I want to build on that framework, but I want to add mostly net new content, net new ideas today that are more specific to the Kraft Heinz situation and just give everyone here a world of insights and ways of thinking about these situations as a dividend investor. So a lot coming your way. Let's get started. All right, everyone. So first and foremost, I just want to go through a quick summary of what was in the General Electric video, because this was a while ago. And if I have a stock, if I'm trying to determine whether I should buy, hold, or sell, I generally look at these criterias. One, what type of investor am I? Am I a long-term investor or short-term? Some people, for example, may be looking to buy Kraft Heinz here to sell it in 6 months when it pops up a little bit. That's one investment strategy. But in general, I want to put that off the table. This channel right now is for dividend investors. So the type of investor I am is buy and hold forever, more or less. And so that is the overall framework. But again, ask yourself, if you're a different type of investor, you may approach this situation really differently. Next one is the dividend cut, temporary or permanent. Generally speaking, if a company I own completely eliminates the dividend or mostly eliminates it, and I think it's going to be gone forever, that's probably going to be a sell situation for me because I invest for cash flow. And if my cash flow is gone, there's no reason for me to hold that stock. Kraft Heinz, by the way, they cut the dividend by 36%. They didn't eliminate it. Yeah, it's a big cut, but I don't think that they're going to lower it more. So I don't think the dividend cut is one going to be completely inclusive or permanent. It's a cut. I think the cut that they did make will probably be around for a while. Maybe they'll increase the dividend again in the future. But certainly it's, we'll get more into this later, but it is not the worst situation in the world. I don't think this is like a permanent, complete dividend cut type of situation. And so just something to keep in mind. Why did I buy it? In general, I only like buying stocks that I bought because I love them. I did the analysis. I have the conviction of them. If I completely bought a stock because someone else was talking about it, then I start doubting myself, and then it probably doesn't have sense in my portfolio because I like to buy and hold forever. And if something is not brought into the portfolio on my own conviction, it's really hard for me to hold forever. That's really what happened with BBL, by the way. I didn't buy it based on my own research. Look, I did the research, but it was mostly based on community conviction. It was mostly based on, hey, everyone has it. I'll make the numbers work. I'll make the research work to buy it. That's kind of where I was at. And so with Kraft Heinz or with any other stock, ask yourself, did you buy it based on your own conviction, or was someone else whispering in your ear? It is so important with dividend investing to take your own path, because the conviction that is required to live off of dividends, it takes time, it takes decades to compound that income, and it truly requires conviction. So was there a fundamental change? Usually if your stock is going down, look, there's a fundamental change. This one kind of bothers me. Everyone says like, hey, the stock's down. Well, did the fundamentals change? A lot of the time, especially in these fire sale situations, look, the fundamentals change. Like sometimes I talk about stocks here that they just fall all of a sudden for no reason. I guess that's a case of the fundamentals not changing. I jump on those opportunities any time of the day. But look, we're talking today about major drops. If I own a stock in my portfolio, there's a major drop. Usually the fundamentals changed. If the fundamentals change, that alone is not reason for me to sell, quite frankly, but I want to look pretty deep into what is going on. Do I want to hold it forever? So usually if I buy a stock and then I change my opinion, I don't want to hold it forever, that's actually a good reason to sell. Do I feel good about it? Talked about that already, but I've got to feel good about the stocks I own. Got to feel good because I buy and hold forever. Are there better alternatives? And can I harvest it for tax loss? Anyways, I don't want to spend a lot of time on that, but that is some of the stuff I covered in the General Electric video. Check out that decision tree, because if you own a stock now, like Kraft Heinz or anything else, you're thinking about selling, that decision tree helps break it down objectively. You can even write it down on paper. Answer the questions one by one, tally up the answers. It will help take something that's potentially emotional into a very logical situation. But I really want to talk about some other factors that are net new that I think are really interesting, especially as it pertains to Kraft Heinz. So first and foremost, Did you buy this stock because a famous investor such as Warren Buffett owns it? This, in my opinion, is such a flawed and majorly wrong thing to do as an investor. I'm speaking from my personal situation. I'm just speaking about my personal philosophy. Maybe this kind of thing works for other people. But in general, I try not to believe what the media is saying, what world-renowned investors are saying. Look, Warren Buffett has done very well for himself. That is good for Warren Buffett. But in general, I believe that the big investors, they are doing what is right in their own interests. Just because they buy something does not mean they're making the right decision. And quite frankly, some of these investors, they may want to see it go down. Maybe they don't care if it goes down. Maybe they have other reasons behind what they're doing. If you watched my video, my initial video on Kraft Heinz that I'll link to in the description below, you may not know, but Warren Buffett had some preferred shares in the Heinz company that when he contributed Heinz company to the Kraft Heinz deal and all that financial engineering was happening, he was getting a 9% preferred dividend on his shares for many years. And in fact, the amount of money he was getting per year was $720 million per year, which when I read an article from, I think it was Forbes or Fortune, one of those publications, the money actually wiped out all of the earnings for the company for an entire year. And so what I'm trying to say here is there are things going on behind the scenes that maybe the average investor is not aware of. They just think, hey, Warren Buffett owns this company. Oh, he must just own the common stock like I do. No, that is not the case. Warren Buffett, his preferred stock now has gotten bought out, thank goodness. But for several years there, he had this preferred stock outstanding, and that preferred stock was generating, again, I will repeat, a 9% dividend. So while your dividend got cut from 62.5 cents to 40 cents, many years prior, Warren Buffett, through his preferred shares, had a 9% dividend yield, yielding $720 million per year. And so that, again, that preferred stock got bought out and it's gone now. But again, just something to be aware of. And again, I'm not trying to put down Warren Buffett. I think he's a wonderful investor, a great investor. But Warren Buffett is a very savvy businessman, and he is cutting deals that are in his best interest. And so again, if you're out there and you're like, hey, I'm just going to try to mimic Warren Buffett, I'm going to try to buy the stocks that he's got. Well, you can't do that, because even if you buy the stocks that he has, he may have different classes of shares, different agreements, different structures, different things going on that might make a lot of business sense for him, but no business sense for you. Again, another way I look at this, and it's just a shame, these guys are cutting their dividend. Why are they cutting the dividend? They got to free up some cash. Why do they need some cash? Probably to pay down some debt, maybe make some acquisitions. But what's funny is, just think about the hypothetical, these preferred shares never existed. These preferred shares paying 9%, $720 million per year, if those never existed in the first place and Warren Buffett never got his 9% dividends in the first place, maybe they wouldn't have to even cut the dividend now. And so maybe they wouldn't need to free up cash, because maybe they would have already had cash from not wasting all that cash on that preferred dividend. And so again, there's a big picture here. This is a global game of chess. There's a lot of financial engineering going on. I try to stay away from stuff, quite frankly, that have these big shareholders. And shareholders, Buffett, thankfully, is a buy and hold guy in general, but there's other investors out there, so-called activists. I can't stand when I see them hovering around companies that I own, because I just want companies to be able to operate, do their thing, grow organically over time. When the financial equity comes in, when the private equity comes in, when they start playing these games, that's when I've seen things blow up. I'll name another one, Toys R Us. And so that is a company, potentially, if private equity were never involved, would still be standing to this day. I don't know if that's the case, but that is one hypothesis that I have read. And so anyways, I try to stay away from it. So the key takeaway, though, is you own Kraft Heinz or you own anything else, if you bought it just because of a big investor was in it who you respect, think twice. Don't just go and sell it now because I'm saying something here. Again, it's a bar of soap. You got to think carefully about handling the portfolio, about selling positions. But going forward, on a go-forward basis, is this a learning lesson? Is this something that you can learn from? I try to stay completely away from these big guys. Number two, how much money is in the position? So if I have a position and it just tanks, it's a falling knife. This is an example of a falling knife. When something goes down this much, it's just a complete disaster of a company, disaster of a stock. Quite frankly, it's an embarrassment to the management team and to the big investors who are behind this thing. It is an embarrassment. And so the fact of the matter, though, is if I owned this, is it my number one position? Do I have 10% of my portfolio on it? Do I have 25% of my portfolio? Or like me, I have 40 stocks. Is it a small position, maybe 1 or 2% of the portfolio? Look, if it's a small position, I got 1 or 2% of the portfolio in it, and they cut the dividend or they have some issues, whatever. That is so insignificant that I just have better things to be doing. I don't worry about it. But if it's a number 1 or 2 position, I got a bunch of money in it, that might reframe how I think about selling. In that case, maybe I'll sell all of it. Maybe I'll sell some of it just to scale it back. There's different ways to, maybe I'll do nothing, but there's different ways to look at it. I think it's really important to look at how big the position is. Again, if it's a small position, probably doesn't much matter. Now, speaking of position size, I want to talk about a dividend cut. A lot of dividend investors think, hey, they cut the dividend, I got to sell this thing. They cut the dividend, I just got to get out of this company. I got to sell the stock, I got to leave the stock because the dividend is gone and I invest for dividends, my cash flow is gone, oh no. And so we already talked about this a bit up here. If the dividend cut is kind of complete dividend cut, look, yeah, I agree, I'm out. But even in this case where they did a massive dividend cut, they cut it from 62.5 cents to 40 cents. They cut it by 36%. Even in this case, for me, maybe I'm different than other dividend investors, but I don't worry about this. I mean, this is not good. I do not like this. If it's my number one position, like I said, I would probably scale back, if not eliminate it. But if it's a smaller position or even medium position in the portfolio, I'll probably just live with it and employ a wait-and-see approach. And the reason for that is the math. Let's just take 2 hypothetical situations. In hypothetical situation number 1, I own 40 stocks, and let's say I own Kraft Heinz, hypothetically. Let's say it's 2% of the portfolio. Well, if I experience a 36% dividend, and when I say 2% of the portfolio, I'm actually saying 2% of the portfolio by income. Let's say Kraft Heinz generates 2% of my dividend income that I use to pay bills with, hypothetically. So even though I'm reinvesting my dividends now, by the way. So let's say it's down. They cut the dividend 36%, and that affects 2% of my income. 36% of 2% of my income is only 0.72% of my income. So if this is a smaller position for me, people tend to get so worked up. They tend to get so emotional. They tend to get, oh my God, I lost. I bought a loser. I'm losing money. But the fact of the matter is this. If one practices diversification, this is why I own 40 stocks. This is why I diversify. People question me on this all the time. They doubt me on this. They're like, Ian, you don't need 40 stocks. Oh, yes, I do, because if I own something like this, hypothetically, and it cuts the dividend by 36%, and something like this would never be a core position for me, but usually smaller, look, I'm only losing 0.72% of my income. That just does not bother me. I can make that up. I can make that up pretty much overnight with new dividend increases from other companies. I'll talk about one of those in a bit. So let's take another hypothetical though. Again, I own 40 stocks. Kraft Heinz lowers the dividend by 36%, but this time, let's say it's 10% of my portfolio. Let's say it's my number one stock. Even if it's my number one stock, it's not that scary. If I take a 36% haircut on my number one stock, which hypothetically would be Kraft Heinz, paying 10% of my portfolio income, I'm only losing 3.6% of my portfolio income. 36% of 10% is 3.6%. So you're losing hypothetically 3.6%. Now, having your income overnight get cut by 3.6%, that's kind of problematic, especially if one is living off of dividends. But again, this is why even if it's your number one position, people get so worked up here. They get so scared. This is the last thing I want to have happen is people get scared of dividend investing because something like this happens, especially when they're more junior, newer to the whole investing thing. I've made so many mistakes over the years. I avoid a lot of them these days, but it's only because I've been doing this for over 20 years. But anyways, the takeaway is when you look at the math, these dividend cuts, yeah, it's bad, and it's especially bad if it happens across the portfolio in multiple companies. it's a one-off situation and you're like me, you own 40 stocks, even if it's the number one position, it's not that bad. But again, taking a 3.6% income haircut, I don't like that. That's not good. That would really concern me. But again, if it was a smaller position and it was only in this scenario, 0.72%, doesn't really concern me as much. And so it shows how weighting in the portfolio really matters quite a bit. But I just want to reframe this whole thing as well, because dividend cuts, they get so much bad press. They're so scary. And like BHP Billiton completely, I got out of that thing. Dividend was going down. If I just held till today, they brought it back up. I'm fine either way because, like I said, I redeployed the money in other wonderful investments that did really well. But again, it's like a bar of soap. And so certainly I don't see Kraft Heinz being the kind of company like General Electric that pretty much is going to eliminate the dividend. And so I definitely don't think it's a GE, as I mentioned in my last video. Okay, so I want to talk about another point. When things are their worst, usually they're kind of close to an inflection point. So this is kind of scary as an investor as well when one is trying to determine, should I hold it? Should I sell it? Well, the worst feeling is when you sell something and then it goes right back up. And I'll give you a good example of this. Someone was asking me maybe a few weeks, month or so ago about Pacific Gas and Electric Company. This is a California utility. The company has been under a lot of pressure. It was all the way down like in the $7 range. It's and they're wondering, should I sell? It just seems like they're doing really bad. They're announcing this bankruptcy, and the company was facing some serious challenges. Anyways, fast forward a few more weeks, a month or so, it's back up at $18.52. So when things look their worst with Pacific Gas and Electric Company, and a lot of people were thinking, hey, should I sell this thing? Is it going to go under? That was the inflection point, and now it's back at $18. And so the key I found with investing is to be very careful. This is, again, why the bar of soap analogy is so important. It's like an elastic band. If you bring it too much down, it's going to snap back up. Or if you bring it down just a little, it's going to go back up a little bit slower. And so this thing, Kraft Heinz, has fallen, and potentially it'll snap back up. Another example actually is General Electric. When that thing was hitting its lows, it's actually snapped back up since then. And for me, I knew that would happen, but I'm still not a fan of GE just because it's not consistent with my investing philosophy. One, I don't have an idea of what's going on at that company. Two, I don't have any confidence in their business. And three, they're just paying an insignificant dividend that I don't ever see going to the point where I can live off of it. So it didn't make sense for me. But from a stock standpoint, even if I'm kind of in a stock, one option when things look their darkest is just to wait and think, hey, should I sell now? Or maybe just wait a month because it might snap back up. And so that's kind of a decision with selling as well. With Kraft Heinz, look, if I owned it, I'd probably just keep it. But let's say I owned it and I wanted to get out of it. The question is, do I get out of it now when it's trading at a 4.8% dividend yield in the low 30s, or do I wait for it to snap back up maybe into the high 30s or even the 40s before I sell? And so there's issues of timing as well, which are really important. But you just want to remind yourself, if you are considering selling, when is the right point to sell? Because it may snap back up. And so the last thing, I just want to talk about philosophy a little bit. I want to talk about the types of dividend investing. There's two types of stocks generally. There's ones like Kraft Heinz that are basically going nowhere. But look, it's paying a 4.8% yield at the current rates. That's after they lowered the dividend. I think it's kind of sustainable at this point. You're probably locking in. You buy now, more or less locking in a 4.8% dividend yield. I don't see them cutting it again. That being said, I do think they have a weak portfolio on the Kraft side. I think the Heinz side is strong. Kraft kind of weak. Hopefully over time, though, they can innovate, and quite frankly, the thing is trading at such a discount, and they have enough cash flow and such now with the dividend being reduced that it should be sustainable at 4.8. And so one question is, do I buy now? Should I buy now? I'm not going to buy it again because I own Campbell's and General Mills. I'm fine, but if it goes on fire sale, maybe I will. But the question is, there's kind of a tale of two stocks here. One option is to lock in 4.8%. Or if you're just going to hold it, that's another way of looking at it, not if you decide not to sell. But another option is to buy a completely different kind of stock like Home Depot. Home Depot, and I'm excited about this. I'll link in the description below. In my last video, I shared how in general I'm seeing dividend increases slow down. And I saw this with some of my holdings like 3M. Dividend is growing a little slower. all of a sudden, one of my subscribers today on Twitter said, "Hey, Ian, did you see the Home Depot dividend increase?" And oh my gosh, I didn't until he showed me. Home Depot did a 32% dividend increase. Nice work, Home Depot. I love you guys. So with its 32% dividend increase, Home Depot, it has a low starting yield, but you compound that for just a few years and the yield on cost opportunity is huge. And so I'll give you an example here. I first started buying Home Depot in 2014. I started buying it at $74.50. If I take the current dividend with Home Depot after the current increase and I divide it by my purchase price, my yield on cost is 7.3%. I am yielding on cost 7.3%. And so I don't need my money now to pay the bills, but I will be using my dividends to pay the bills. And so the question becomes, if I don't need the money to pay the bills for some time, is it better to buy a stock like Home Depot, where I can get a yield on cost after just 4 or 5 years of time of 7+%? Or do I buy a stock like Kraft Heinz that's yielding 4.8% now and will still probably be yielding 4.8% on cost in 5 years' time? That's the question. But it just kind of opens up the discussion here that when a stock is falling like this, are there just better alternatives as well where one can redeploy the capital? That's kind of what happened with BBL. Look, I would have been fine if I held it, but there were other stocks out there. I don't remember what I put my BBL money into, but I'm surely glad that I bought the Home Depot back when I did. I'm experiencing some of those massive dividend increases and the great yield on cost. And that's the magic, by the way, of dividend investing, is the concept of yield on cost. Just buying here, having the dividend increase over the years, and then having your new income divided by the amount of money you invested in your yield on cost. It can go way higher than what the current starting yield looks like. And that's the beauty of dividend growth investing. But you look at a company like Kraft Heinz, there's no real good concept of yield on cost, because your yield on cost at this point, I would just assume, is always going to be 4.8%. Dividend's probably not going anywhere, and if it does, maybe they'll bring it back up from their 40 cents to the 62.5, but we'll see if and when that happens. I don't have a lot of confidence in the company at this point. I think it's more going to be a steady Eddie dividend increase. Anyways, there's a lot of thought and different topics in today's video, but I just wanted to go through it because this is such a wonderful case study. And so again, to summarize, if I'm going to consider selling something, I look at all of those factors that I discussed last time in the GE video, and then in today's video, I look at it basically, did I buy it just because of a famous investor? How much money do I have? I look at, is the dividend cut really going to impact me? Because I think you see a dividend cut, it looks scary on the surface, but when you dig into it, is it really going to hurt my income that much? Usually the answer is no. And then I just run hypotheticals. I look at my portfolio diversification. I look, am I going to sell this thing at the turning point? But then I look, if I do redeploy the capital, or just when I'm deploying fresh capital, do I add to the loser? Do I put more money into the loser to average down? Or do I just go a completely different direction and buy something like the Home Depot, where I can get a good yield on cost and the company's doing well, and it's growing the dividend, even though the starting dividend is really low? And so I don't have an answer when I sell, when it's the right time to sell. Oh, there's this metric or this trigger that tells me to sell. It's so many things, but in general, bringing it back, I've gotten to the point where investing is kind of like a bar of soap for me, and I don't like to sell. And so, like I said in the last video, if General Mills cuts their dividend, I'm not going to sell unless they eliminate the thing or they cut it like more than 50%. But if General Mills, let's say, did the same thing as Kraft Heinz. By the way, I don't want to scare you. I don't think General Mills is going to do this, but let's just say hypothetically they do. I'm not going to sell it. And that really goes for pretty much any position in my portfolio. Oh, there are one or two in the portfolio that I could live without. I'll discuss some of those in the future videos. Maybe if they cut the dividend, it would be different. But again, I generally think like it's, bar of soap philosophy. So I'd be curious, do you own Kraft Heinz? Are you considering selling? Are you adding more? Are you buying? How do you look at the situation? Look, it could be a good time potentially to buy, because it could be at an inflection point. And if you're what type of investor are you? If you're a shorter term investor or mid-term investor, maybe it's a good opportunity to buy and buy low, sell high. That's not me. I buy and hold forever. I don't really care about capital appreciation. So completely different type of investor. But I'd be curious, share in the comments section below what you think. And putting Kraft Heinz aside, just in general, when do you sell a stock? You guys kind of know with me now, I really don't ever sell, but at least these are the factors that I look at. And the one time I did sell BBL, it was because of that. I did sell, by the way, Dr. Pepper Snapple, actually. I'll link in the description below about that. That was kind of a one-off thing. It's just I made a huge gain on that thing, and they were getting acquired and going public again with the Keurig company. And I just, again, it was kind of didn't want to be part of that private equity financial stuff that I was speaking about earlier in the video. And I have enough exposure to soda in the portfolio, so I just wanted to redeploy profits into other companies and lift up my yield because I was able to take the profits and buy higher yielders. So that was kind of a particular case as well. But it's all particular cases for me. Very particular, very, very case by case. So thank you. Before I leave today, in terms of full disclosure, I am long. I own the stocks mentioned today, or at least some of them. I own 3M, ticker symbol MMM. I own Campbell's Soup, ticker symbol CPB. I own General Mills, ticker symbol GIS, and the Home Depot, our amazing company that just raised the dividend by 32%, ticker symbol HD. I own all of those in my personal stock portfolio. Also, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. Literally just sharing my videos here on YouTube for fun. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Hey everyone, I love this community. We are growing really quickly here. Thank you for being part of the dividend investing community. We're dividend investors supporting other dividend investors. Share in the comments below when you like to sell a stock. I will see you all in the next dividend investing video.